This last week has been quite tumultuous. The former FDIC chair has come out and said that he thinks this feels a lot like the 80s. If you don't remember the 80s, which I don't really remember the savings and loan scandals, but a lot of banks went under, and he's saying this feels a lot like it. Is he right? Is he wrong? I have no idea. Our goal here is to sit there and look at every situation and the data we're hearing and kind of tell a story about the future, right, Mo? Mm-hmm. CPI just came out this morning. Yeah. And that's why stocks are flying or maintaining and increasing.
Yes, I would say that's correct.
So CPI came in at 6% versus 6.4% last month, and it was an increase of 0.4%.
Yeah, versus 0.5 last month.
0.5 last month.
Yep.
Now, one piece of bad news, core inflation, which excludes food and energy, was up 0.5% versus 0.4% expectations, right?
Yep.
But now banks are up a lot. The market's enthusiastic. Yesterday was a really up and down day. It was actually quite crazy at one point.
Yesterday was wild.
I mean, you were traveling.
I was traveling, so I was kind of looking at my stocks app when I can see, and it's just like, wait, we're up 1.16%. Now we're down. What is going on? It's in every different direction.
Yeah, and we started down big yesterday.
Yeah.
And that's what we're here to do as a channel. So we've gotten a lot of new subs after these videos went out, and that was great. Our goal here as a channel, our goal is to sit there and look at investments. We look for opportunities. To me, a lot of green sucks. I don't like seeing green. I just put on Twitter, and actually follow me on Twitter if you want. But I just put on Twitter like I hate green days. Like I literally get excited over red days. And you're probably watching this, and if you're like everybody else in this world, you're probably like, wait, what? Why do you hate? I just put a quote up in our community over here. Every day I put a quote up and talk about it, but this one had to do with investing, and it said, the market's basically the only place where everybody runs out of the store when there's a massive sale.
That's it. It's really amazing. I mean, when you're buying a company and it's red, you're buying it cheaper.
Yeah.
You are buying it on sale. It's like getting it 10%, getting a shirt 10% off. Why would you not want that?
You'd always want it to go lower, unless you're going to retire tomorrow,
right?
Or in the imminent future. Exactly. You don't want things, and that's what we're trying to get to as a channel. We look at individual stocks for that reason. We want to show individual stocks and use our 8 pillars and our stock analyzer tool in order to determine what the value of the stock is today based on our desired return.
And we also keep things in perspective. Like, this has been a crazy week.
Yeah.
But it's just a crazy week. There have been banking chaos in the past. There has been, when we look at quarterly earnings, we do quarterly earnings reactions, but it's not because we're excited about the quarterly earnings. It's just, let's see the price reaction. Let's keep things in perspective. Let's look at the long term.
Yeah, and this is what I do all the time. I pull up the S&P 500 ETF going back to 1993. And I always joke and say, guys, the world looked awful here, looked pretty bad here, it looked really awful here. And if I told you right now, pick 4 times in the last 30 years in which you'd want to invest your money, you'd have picked all 4 of those times. Right? Mm-hmm. And you look at back here in 08 and 09, if you invested here versus here, 6.5% a year to today, 13.5% per year to today. Guys, it just makes sense. The less you pay for something, the better you'll do, right? And this is why we encourage dollar cost averaging into a low cost ETF. Individual companies, unless you're going to have a portfolio of good individual companies, it is possible for an individual company to go to zero. Look at Silicon Valley Bank, Mo.
Absolutely. A couple days, they were gone.
Literally in a couple of days.
Yeah.
2 weeks ago, it was a $250 stock. $250, maybe even less than, it might have been just last week, Tuesday.
Yeah.
And now it's zero.
Yeah, it's zero.
And that's why we encourage you, only buy companies that you understand. Banking numbers, we don't even understand banking numbers.
So it's funny. I was texting you. I was like, man, I wish I understood Charles Schwab, because it was down 21% yesterday. And conceptually I look at it and say, this is Charles Schwab. I don't see a situation where Schwab goes away, but I don't understand it. So I'm not going to do anything.
And I bet you a lot of people said, I don't see a situation in which Silicon Valley Bank goes away.
And people probably said, I don't see a situation when Lehman Brothers goes away.
Yeah.
And these are things that you have to say, do I understand this? If I don't understand this, I'm going to pass.
By the way, did you see that thing circulating on Instagram and Twitter about is it the guy who was at Bear Stearns or Lehman also was running? Was it Lehman? He was also the guy at Silicon Valley Bank, and he was somewhere else before. It was like he was literally 3 for 3 on financial disasters.
Yeah, he's really good at his job.
Yeah, so understanding banks is difficult, and we sit there and say in our state, it doesn't mean we don't want to learn banks.
Absolutely.
We have a banking analyst that we talk to. He just can't come on the air. And we're going to learn from him tonight a little bit more. But our goal is to find companies we can understand. It's easy for me to understand the balance sheet of a company like Google. So let's pull up Google here just to show you what I mean by that. So guys, if we look at the income statement, the balance sheet of Google, there's no, like when you go to a bank and you give them money, that's now a liability for them because they owe you that money back. But they can take that money and go lend it out. And if the reserve requirement's 5%, that means that the government only requires them to keep 5% of the money that's owed out to depositors in their bank accounts. So if you all of a sudden have 10% of the funds being requested to leave, that's called a run on the bank. And all of a sudden they can't cover that. Yeah. And that's what happened with Silicon, in very basic terms, that's what happened with Silicon Valley Bank. Go ahead.
And these runs can happen a lot faster now because we live in a digital world. It can happen like that.
Yes. And speaking of digital, a lot of people are arguing, see, this is the point of crypto. If you believe that, I'm sorry, just turn the channel off. This is not for you. I understand. It's the argument for maybe a decentralized currency, but at the end of the day, you've got to realize the reality we're in. And the reality we're in is that the US government wants to be able to control its money and the money flowing in its economy. And that's not going to change anytime soon.
And I will say, for the people that want the decentralization, where's the first place they turn when there's chaos? The U.S. government.
Look at crypto people. Look at Kevin O'Leary. The government needs to be there. Okay. So anyways, back to Google. I look at this, 165 billion in current assets, which is essentially cash, and total liabilities of 109 billion. I look at that saying they could write a check, pay off all their liabilities essentially, and still have $60 billion left over. Yeah. That's a balance sheet I can understand.
A bank, it's hard to understand.
Yeah. And I look at things like our 8 pillars here. I can understand these 8 pillars. I can look at this saying, okay, and by the way, I repeat this over and over because we want our users, all of our thousands of users here, guys, you can make your own pillars here. Make your own pillars. You can do up to 12 pillars, and the combination's literally in the trillions based on all the data we pull in. But I look at this saying, I can understand this. I understand this when it comes to a company that sells a good or service. I understand this. I understand all of these pillars. Cash flow growth, multiple of earnings and free cash flow, return on invested capital. And these are the things that you will learn more and more as you watch us more and more. And you're not going to become an expert tomorrow. We don't even consider ourselves experts.
No.
We're just constantly learning. But the more you learn, the less you fear. And also, the more you learn, the more you realize you don't know.
Yeah, and there's a lot you don't know. And that's not a bad thing. Charlie Munger says there's a lot he doesn't know.
He's 99 years old. He reads hundreds of pages a day, supposedly.
Yep.
And that's the key to getting better at investing. It does take time, but it's not like you hit some point and go, all right, I learned. No, it's probably more like this. But these incremental changes right here are very important when it comes to learning about investing. But the most important aspect, and the reason you're probably watching this today is you saw a video in which you had a little bit of fear and said, this could help explain it. And you subscribed because this helped explain it. That's why I want you here. We want you to understand that the hardest part about investing is not this. This is not the hardest part. This software definitely makes it easier for you to find good deals and better companies. But the hard part is, if this in the next 6 months went to 50, do you have the ability to buy more? It's easy to say you would today. I've heard it 1,000 times. Oh yeah, I definitely buy more. But for it to go to 50, the story would have to be really bad. Literally the point where people are probably saying online advertising is going away, YouTube is going away. The top 2 search engines are Google and YouTube. And Google owns both of them. The question you have to ask yourself is, whenever you're looking at a company, if the price falls, is it a rational fall? What's the reason for the price falling? Are the fundamentals in the business still the same? This is also why we talk about when you look at the profit of a business, when you look at the income statement, what's the stabilized profit? Not when times are booming. Anybody can make money when times are booming.
That was proven in 2020, 2021.
That was also proven in 05, 06, 07 with real estate. How many?
Tech bubble coming into 2000.
Every bubble. This is why we're against crypto. Part of the reason I'm against crypto is so many people like it and so many high school kids and college kids try to tell me I don't get it. And people who have no business telling me I don't get it. Who couldn't even tell me what an income statement and balance sheet are. And they're like, Paul, you don't get crypto. That's what makes me go, if you just invested that way, where you just talked to average people and said, what do you like? And if you just avoided what they liked, you'd probably do pretty well.
Yeah. It's like a cocktail. Cocktail theory.
It's exactly the cocktail party
Cocktail
theory.
party
By the way, you know what I saw?
that?
Michael Burry, I think, has some big value investor has BlackBerry stock.
Really?
Yeah, and you would have thought to yourself, like, BlackBerry? Who
am
is
thinking
it?
to myself, BlackBerry.
Well, yeah, that's the thing. But that's the thing, guys. We all have these iPhones.
Yeah.
We don't think about
I have
BlackBerry,
not seen a BlackBerry in years.
but they're awesome. I love the BlackBerry.
BBM.
I never used BBM.
I never did either, but I had a BlackBerry.
Yeah, so did I. I liked it a lot.
Yeah.
And the reason I liked it so much, you could market text as unread. And now, thank you. By the way, Lisa the other day goes, wait, you can market text unread? And I was just like, where have we been, Lisa? So anyhow, interest rates rising. It's going to fight inflation, but it's also going to cause job losses. That's just the reality of it. You know, I read, who was it? Ken Griffin of Citadel said today we're at full employment. No, we're not. He literally said those words. I read it. I'm like, wait, no, we're not. Full employment's like 5 or 6%.
Right.
That's where that's where the Fed has two mandates: full employment and price stability. Price stability is basically inflation, right? Where do we go from here? Well, they see high inflation. They want to fight it. Their increasing of rates has shown to be working. Now, the question is, what's going to happen March 22nd? What do you think is going to happen?
I think they're going to raise interest rates by 25 basis points.
Yeah, I hate it, but I think they're going to too.
I think they're going to do it.
I think they're going to use this as an excuse as well as inflation data. Even though core inflation's up, I think they're going to use this. As much as we like to sit there and say that the Fed's an independent body, when you see Fed Chairman Powell on TV answering questions from idiot Congress people, asking them stupid questions, it's just hard to be completely independent.
Right.
I mean, people are blaming, and Congress people who are supposed to be smart are asking him asinine questions like, hey, can you explain to me how stock buybacks are increasing inflation? He's like, they're not, it's not. I remember when I heard that, I just, my head, like, literally I did a twitch and I thought I had a stroke. I was like,
They try to sound smart.
Of course. But I think your predecessor, Bernanke Kay, what did she say?
I didn't hear that.
Oh my God, she didn't even know who Bernanke was.
God almighty.
It was incredible.
Wow. NASDAQ's up 2.15%.
Oh, it was 2.22 at one point when we started the video, so we're making progress.
All right.
So guys, this is what we're trying to do. We're just trying to we're not trying to react to short-term news. I don't react at all to short-term news. At all.
Something I found funny yesterday, I was looking at KeyBank, because it's a regional bank.
Yeah.
This thing was down at one point 27% or something crazy like that. And today it's up 16.5%. What has changed in that company? What has fundamentally changed for the swing either way?
It's either really bad or look.
News in some direction, I guess.
And this is what we talk about when we talk about
fundamental.
Efficient market theory. There's a theory out there called efficient. They teach it in all the schools, and every professor sounds like they're so smart when they say it. I wish I could go back to college. And the first time I heard it, I still remember which room I was in. I wish I could just go ha and just laugh out loud when the professor was talking about it. And here's why. Look at Silicon Valley Bank. 2 weeks ago, the reality was there of what was underneath the books. But just because the market didn't know it. In efficient market theory, the idea is if it's the stock's at $250, it factors in all information there. Well, it didn't factor in the information.
Right.
It didn't. And there were people out there who understood that there was the reason Silicon Valley Bank had a problem was they were taking short-term cash requirements, depositor money, and investing it in long-term bonds in the government. Now, when the Fed raises rates, what happens to bond prices? They go down. Rates go up, bond prices go down. Rates go down, bond prices go up. So when you're buying a lot of bonds at 2%, 10-year bonds, for example, and they go to 4% or 3.5, you lose almost half your value very, very quickly. So all of a sudden, what happens? Well, you have a mark-to-market loss or you take a realized loss and you have to raise capital because the government requires you to have certain capital requirements within the business. Right. What are you pulling up over here?
This is the bank. It on
February 1st, it was 333.
333.50.
Didn't you tell me to short it on February 1st?
I did. Did you do it?
I did not.
Dang.
By the way, I heard a rumor, and I don't know if it's true. I don't know how it works. And this is exact example. Like I have no problem acknowledging what I don't know. I heard that people who maybe had shorted this through options, like maybe had sold a call, not a covered call, a call on it, would have not been able to get their money.
Oh, really?
I don't know how that's the case, but because to me, it's just, let's say I bought a put on it. Let's say I bought a put at 250. Right. Well, yeah, here's your shares. Give me my 250. Like exactly. I'm forcing you to buy the shares.
Interesting.
So either way, This is what we're trying to do as a channel. This is what we are doing as a channel. We don't hide from what we talk about. There's over 2,100 videos out there. We don't follow the hype. We don't follow the itty bitty news. And we believe that in the next 5 years, a lot of these YouTube channels that act like when they just found one Tesla stock, they rode up high and act like they're experts.
I met a guy in the airport yesterday.
Yeah, we get it, Mo. You're recognized all the time.
Actually,
You got recognized twice.
Twice in the airport. But he was like, I really love your guys' channel because there's none of that hypester BS. And you guys are he's like, I've been watching you for a year and a half. You guys are extremely consistent.
That's awesome.
Yeah.
And that's the thing.
It's good to
and
hear.
then go look at the hype stuff that we set there instead of void. It's all down an insane amount. Now, our stocks are down, and they will probably go down further. The difference is when our stocks go down further, we go, all right, let's go here, baby.
Even a better value.
If you buy it based on hype and based on excitement, and the stock falls, what's your reason for owning it?
It was high. Maybe it'll go back to that price.
But there's no fundamental reason.
Exactly. There's no reason for it to happen.
That's the point here. So guys, I need you to do me a couple favors. 1, subscribe to the channel if you're new to it. And 2, even if you're new or not, doesn't matter, because be like the other 75%. Go look at the number of views we have in this video. 75% of those views are subscribers. We are exactly the opposite of other channels. Most channels have 25% of their viewers are subscribers, 75% are not subscribers. Ours the other way around. It shows how dedicated our subscribers are. So subscribe to the channel and share this with 4 or 5 other people who would find a lot of value in this, because I guarantee that when times get tough, you're going to want to have your Uncle Paul and your Uncle Mo sitting there holding you and telling you things will get better. These are times to buy. And that's the reason why you watch us. That way, when times are bad, you can sleep well at night. Thank you very much.